Welcome back. It's Kim Woodul with Ebby Halliday.
I'm Bill Hoyt with PrimeLending.
And we're doing the modern home buying experience, and we're in a new location today. We're here at the Ebby Halliday office. So today we're going to be discussing sort of the current market conditions and what's going on in regards to the interest rates being higher than they have been historically in the past few years. So Bill's going to be discussing 3 different loan products that are alternatives to just the regular 30-year fixed mortgage. So what are some options for buyers that might be a better alternative?
There's strategies, and some of them actually work in tandem with each other. But the first one would be an adjustable rate mortgage, also known as an ARM. And the second one would be a temporary buy down, such as a 2-1 buy down, which we'll discuss. And then the third is a product that's exclusively offered by PrimeLending, and it's called a rate redo.
Okay. So let's start with the adjustable rate mortgage. Historically, they've had a bit of a bad rap because it is a variable rate. But in the current climate, that's actually a good thing.
Right, because what goes up comes down. And so we've got, one of the nice things about an adjustable rate mortgage is that a lot of people don't know that there's a fixed period. It could be 3 years, it could be 5 years, or even 7 or 10 years. For the first, those years can be fixed.
Okay.
And it doesn't start to adjust until later on.
And that's awesome because the average homeowner is in their home for 5 to 7 years. So it could be that you can get into a home at a lower interest rate than just a regular mortgage, and that you might be trading up or moving to a new city within 5 to 7 years, which is the average. So in that whole time that you're in the home, you've enjoyed a better interest rate.
Right. And, what's really important to know about adjustable rate mortgages is that there are, the first thing you want to do is select how long of a fixed period you want. The second thing you want to select is the frequency. In fact, once it does start to adjust, how often? Because some of them adjust annually, and other more recent loans and ARM products that have come out are adjusting every 6 months. So there's that. And then the third thing is that each of these loan products also have different caps that give you a little bit of peace of mind knowing that that interest rate is not going to exceed X amount per either the initial adjustment period or every period adjustment or even a maximum over the life of the loan. That's
awesome. So what's an example of that?
Okay, so let's just say that you've got a 5-1 ARM. It's fixed for 5 years.
Okay.
And so at the end of that 5-year period of time, the rates start adjusting, and let's say it's a 5-6. So that means the second number is that it's going to adjust every 6 months.
Okay.
So in that initial adjustment, we're going to say in this case that the caps are 2, 2, and 5.
Okay. So after the first 5 years they're in the home,
right,
their interest rate can jump
from 5 to 7.
Okay.
2%.
Okay, which is what the current market rate is.
Right.
So it's just as well that you did a regular mortgage right now at 7%. You would be no worse off than that. You'd actually be better off.
Right. But the other part of it is that every 6 months, on a 5-6, every 6 months that rate's going to adjust, and that period adjustment is 2. Okay. So in 1 year, it could go up 4%. But that would only be if interest rates just continue to go up like this, just like that. And they're not going to do that. Interest rates do this.
Okay. And then there's also a lifetime cap. So
right.
It's not like it's just going to keep going on up into perpetuity.
That's the third number, and that's the 5, which would be, so you go back to that initial rate and you add 5% to that. That means the lifetime cap on that mortgage could never go over 10%. And if rates are at 10%, if it does hit that cap, most likely rates are going to go on up to 12, 13, 14%. And so at that point, even if it maxed out, you're at a better rate than what market rates would be.
Right.
So it's a win-win. I mean, you get a lot of people, actually every time the rate lowers, because that's the next part. This thing can go up and down, and if it goes down, then you get the lower interest rate and the lower payment without having to pay the cost of refinancing your loan. So that's a great benefit.
So to recap, getting into an ARM loan product, you could enjoy a lower interest rate right now, and you could also maintain that lower interest rate until naturally you might be trading up out of that home anyway. And then there's also the opportunity that that adjustable rate could adjust down. So
Right.
if you're interested in learning more about an adjustable rate mortgage, contact Bill Hoyt at PrimeLending. And if you're interested in the topics that we're discussing and would like to like and follow and subscribe, please do so. And if you have any questions about other, loan or home buying products, let us know in the comments below, and we'd love to discuss that in a future episode.